Bitcoin is actually one of the purest liquidity correlations that are out there. Essentially, I think that liquidity, at least locally, reached its worst point last year, and at least is kind of a mild improvement. I do think that it is a much better debt situation than it was before, at least in that market sense, right? So there's still tremendous amounts of debt, for example, sovereign debt, corporate debt, household debt. But in a market sense, basically debt tied to trading assets, that's been significantly reduced. I think that even though we potentially have seen the lows, I still think there's time to go through before you'd see another just super strong kind of structural rally to new all-time highs. So if you're an intellectually honest person, I mean, you can fit in many different places. I think it's a very inclusive space in that sense. You want to be open-minded, but you also want to be very, very on the lookout for scams and kind of start with the assumption that most of the thousands of things out there, unfortunately, are scams.
In this highlight, Lyn Alden reveals exactly what's behind the 40% spike in Bitcoin that came out of nowhere, taking Bitcoin's price from $16,000 all the way to $23,000. Make sure you stay until the end to find out how Alden believes that the crypto market will respond as more and more cryptos are financially in ruins like DCG and Genesis. Now, let's hear what Lyn Alden has to say.
Over on Cointelegraph, this is basically just talking about Bitcoin seeing its new 4-month high. But at the same time, we're getting some conflicting data. And do you feel that are the contributing factors to what we're seeing right now in Bitcoin's price movement?
So Bitcoin is historically highly correlated with various liquidity indicators, right? So basically how much capital is kind of available liquid for investment. A lot of other investments, they trade off things like earnings, they trade off all sorts of other things, whereas Bitcoin is actually one of the purest liquidity correlations that are out there. And ever since autumn of last year, liquidity conditions have actually been, in many cases, moving up or sideways a little bit. Basically, they declined all throughout 2022. When you got to the end of the year, the dollar index came off of its highs. You started to get Chinese reopening. You started to get, the market pricing in slower forward Fed hiking. Inflation was off of its highs. You had a drawdown in the Treasury General account. It's kind of jargon for some, but basically there's a bunch of things that improved liquidity. And I actually think that, Bitcoin probably would have bounced in Q4 if not for the whole FTX, implosion. Because you started to see a bounce in a number of risk assets. We saw good movements in precious metals, including ones like silver, that are historically more cyclical. And so I think that basically this is kind of a pent up move from those overall better liquidity conditions. I think the somewhat concerning thing is that you're also seeing a bounce in like meme stocks and unprofitable stocks this year. And so, I wouldn't be surprised to see some of this be given back or some of this, consolidate for a period of time. But essentially, I think that, liquidity, at least locally, reached its worst point last year, and at least is kind of a mild, improvement.
I think when, for our audience out there that are listening in on this, one of the key constructs that you have to really remember when you're investing, whether it's in risk assets like, crypto, Bitcoin, et cetera, or you're going in traditional security markets, leverage and also liquidity. Those are two major components that have to be active in the market for it to really kind of perform in different areas, and whether it's in bull markets or bear markets. Lyn, I know you've been kind of talking a little bit about leverage in the market as it is right now. Do you feel like the leverage has started to come off the market? Because we haven't really repositioned back in, but at the same time, we're getting some liquidity, blue sky, it feels like. What's your analysis of that right now? Because it's kind of two different polar opposites of what's happening in the markets.
So in equity markets, a lot of the margin debt has been rolled over, right? So basically, there was, during the big spike and into 2021, there's quite a lot of margin debt. A lot of that has been reduced, and obviously, we've seen a lot of debt implosions throughout the whole crypto ecosystem. That was basically debt built on debt in this big intertwined connection. So I think that's actually pretty healthy. I think there's still some pockets of debt. Obviously, we have to see what's going to happen with Digital Currency Group and that full situation there. So it's not like debt has been totally wiped out, and it's never, in recessions, you don't wipe out all debt from any industry. You just kind of wipe out the excessive debt around the margins. And so I do think that it is a much better debt situation than it was before, at least in that market sense, right? So there's still tremendous amounts of debt, for example, sovereign debt, corporate debt, household debt. But in a market sense, basically debt tied to trading assets, that's been significantly reduced.
We just showed a tweet there by Dylan Clare. He was talking about the issue of DCG suspending dividends. Again, this is just more distress, at Genesis in general. How big of an issue do you feel that this poses to not only Bitcoin, but in general risk assets of what's happening with DCG and Genesis right now?
I think the biggest way it affects Bitcoin is how it affects their Grayscale trust, right? If this allows for redemptions, if this allows for a changing of ownership, if this gets stuck in a bankruptcy court
Right.
for a period of time, I think that's the biggest impact there, because GBT is an absolutely massive holder of Bitcoin. More broadly, basically, I mean, they own large amounts of venture positions throughout the crypto ecosystem. Obviously, they're a major trading desk. But I think it's healthy to go through these cycles and clear out all these malinvestments, because if you just always go up, of course you're going to get more and more leverage piled up. If you saw an investment that only ever goes up, the rational thing to do would be to leverage, right? If you were sure that it was only going to go up. And so the only way that something can go up structurally is that it has to clear out a lot of that debt every once in a while.
Right.
And so basically, I think we still have a process to go through. If you look at historical Bitcoin bottoms, they usually, other than the March 2020 event, usually you don't have these V bottoms. Usually you go down, you crash, you capitulate, you go sideways for a while, and you correct both in space and time, and you clear all that out for a while, and then you start to build, right? So I do think that, even though we potentially have seen the lows, I still think there's time to go through before you'd see another just super strong kind of structural rally to new all-time highs.
It's the community approach. Do you feel like the scenario that's being painted out in the market right now from and around Bitcoin is more inclusive or less inclusive? Because I'm getting, kind of measurements from some people that they feel it's less inclusive. What are your thoughts on how we might see adoption occur in the next run?
So I think it depends on what part of the ecosystem you look at, right? So a lot of people focus on, for example, Bitcoin Twitter, which they might mistakenly assume that's all of Bitcoin, whereas of course that's the more vocal public group. Whereas if you look at the developers, a lot of them, they don't have time for Twitter. They're only marginally on Twitter in many cases, and a lot of times they have very different views from the rest of the space. So I think there are pockets of Bitcoin where if you're an intellectually honest person, I mean, you can fit in many different places. I think it's a very inclusive space in that sense. I think the way I would phrase the parts that seem rough around the edges is that on average the community is very open and aggressive about calling out things that they perceive as scams. And I think that unfortunately this ecosystem has been kind of ripe for scams, because the way I phrased it before is that by allowing peer-to-peer money, the same technology that allows for peer-to-peer money also accelerates peer-to-peer scams, right?
Sure.
So for example, before, if you wanted to scam people, it was like direct mail, things like that. If you wanted to go through investment opportunities, generally that the SEC would be some degree of a barrier. If you want to get someone into penny stocks or things like that, you're still going through the SEC in some way. Whereas this technology is allowed for security basically to be sold to the public in a way that goes around a lot of those other historic safeguards. And I think there's a lot of active debate, I mean, whether those safeguards were ever really effective. But because this technology kind of, at least temporarily, in this kind of arbitrage, regulatory gray zone at the moment, because they kind of go around those, it's sort of a haven for scammers, even though, of course, there are plenty of people that are doing plenty of interesting things in encryption. There are a lot of serious people in the space, but because it's such a haven, there's so much affinity scamming, there's so much pump and dump schemes and things like that. And so I actually think I do think it's good to pay attention to a lot of the people that might seem closed-minded, because a lot of those have been through multiple cycles and have seen a lot of these before. Sure. So I do think you have to balance a little bit, but I do think that it's a reasonable heuristic to have a very, very high bar in this space before you'd consider something investable. I think it's you want to be open-minded, but you also want to be very, very on the lookout for scams and kind of start with the assumption that most of the thousands of things out there, unfortunately, are scams.
I strongly recommend you click this video next, where Lyn Alden breaks down the seemingly unrelated factors that are all simultaneously contributing to the worst bond market crisis since World War II.